Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 79. As always, joined with the three amigos. We got Keith Dicker, IceCap Asset Management, and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. Keith, what's going on?
Springtime, and which is great because, you know, in Nova Scotia, when it's springtime, the first sunny day of the year, everyone wears shorts and T-shirts. And of course, like everyone is so, they're just paisley. They have no tan for a long time. You got that happening. But I had a great conversation this week with a couple. We're chatting with him. They say, we watch the Loonie Hour all the time. And I said, who's your favorite person on the Loonie Hour? And they don't even hesitate. They don't even hesitate. They say, oh, Rich by a long shot. And I said, hey, that makes sense. Then, of course, it comes to the awkward second question. You know, who's your next favorite? And the answer to that one was, oh, Boomer by a long shot. So, Steve, you're ranking pretty low out there. You got to bring it up. You got to raise the game.
Story of my life. Keith, you strike me as like a jorts guy. Are you a jorts guy?
What?
What is a short?
Yeah, no, I don't. I don't even know what they are actually.
I could see you busting out Mrs. Icecap's jorts.
No, I
never heard of visual.
Never heard of jorts.
There's those pasty
shorts
white thighs
and jeans. I can see how you're Rich. What's new with you, man?
Well, I've been reliably informed that this is in fact Alberta. So there you go. Thanks for our keen-eyed listeners and watchers who
Lake
let
Moraine,
us know.
right?
Now I forgot. Now you got me. I just saw the Alberta and I was just like, all right, check. Otherwise, same old. Pretty quiet week this week. Been trying to be healthy and go to the gym. I've been promising a shout out to a good friend, Evan Paperman from Woodland Capital, for literally 7 months. And every time I see him, I tell him I'm going to give him a shout out, and then I proceed to forget. So there you go, Evan. How's it going? He's a loyal listener. Him and his whole team. They're in the real estate game as well. So there you go. There's your finally, after all of these months, I gave him a shout out.
Send your donations into the show.
What does Evan do?
Yeah, he actually works they work in real estate, not quite commercial real estate. They do I'd say flipping, but flipping has like a negative connotations. I'd say like they do it but with a lot of love. Like they really rehabs. Rehabs. They take older sort of duplexes and triplexes, and even I think they're getting into larger multifamily stuff. And they really just breathe new life into them is the way I would probably describe it. They've really, you can see what they've done on their website. And from what I understand, they take kind of shitty old places and turn them into wonderful places for people to live.
Where are they based?
In Montreal. Sorry, I forgot to say
that's about to be illegal in BC.
What do you mean?
I'm not even joking. The BC government.
Oh, okay. Sorry.
The BC government in their infinite wisdom is coming out with they're calling it like a flipper tax. So I think it's like if you buy and resell a home within like 2 years, they're going to like tax you even more so than what CRA would tax you. I don't know. We're waiting for the details, but it's interesting.
My friend's not running a charity. Like obviously they're in it to make money, and hopefully, God willing, he'll make lots of money. But I think but genuinely, I do know that they take stuff that has just been beaten up and uncared for and breathe new life into them, new everything, and then. Yeah, so there you go. They're finally, after all of this time.
I mean,
there's a very long-winded shout out.
Anyone in Montreal that wants some help with restoring an old property, give Evan and his friends a call.
There you go.
Honestly, though, there is like a genuine specialty in doing that. Like to know the right trades and to be able to like execute a product, and then you also have to have like a lot of cash and liquidity.
Now, so when they're doing this, do they wear jorts?
It would make sense logically.
No,
But you
it's
can put
not.
your
You need,
helmet in the loop, right? Don't they have a
no,
loop?
you need
there in-
you need
in the
PPE. You need PPE.
PPE.
dear.
Personal protective equipment. Come on, boys. All right, let's go.
Anyways, all right. So the Bank of Canada, to no one's surprise, we didn't even have a Twinkie bet on it because it was such a shoe-in. But a pause or an ongoing pause from the Bank of Canada. We'll get into that, Rich, some of the commentary from Tiff Macklem, but sort of my quick summarization on it was basically it kind of felt like a bit of a dovish kind of pause. They basically said like things are progressing as we expected. While inflation's still high, it's getting closer towards our goal, and they've gotten CPI headline is CPI inflation getting to 3% this summer. Growth is starting to, they've revised their growth forecasts higher. So they're kind of basically calling for this really soft, gentle landing. But correct me if I'm wrong. I don't know if you read anything differently.
No, that's exactly what's happening here. And I mean, so that the best analogy now is if anyone's ever gone mountain climbing, if you're a climber, you're trying to get to the top and you make it there. And you think, hey, this is great. It's awesome. But the climb's not over. You still got to make your way down. This American climber, Ed Viesturs, if you know that guy, he talks about that all the time. So with, the Bank of Canada and the whole inflation story and stuff, they're clearly on the way back down using, your favorite, inflation metric. And, you're just hoping on the way down, they don't, fall into a crevasse or trip on a rock or an avalanche hits you or something like that. But they were pretty happy with themselves yesterday, and they should, because nothing has broken yet. A few folks got hurt in the housing market, maybe, and I mean that tongue in cheek, because obviously a lot of people are struggling right now with trying to pay for stuff and the increase in housing costs. But from the Bank of Canada perspective, they're continuing to wait to see the impact on the economy, from basically going from 0 to 4.5 in a very short time frame. And remember, not only did the Canadians do it, but the Americans did it, and the Aussies and the Brits and everyone else. And this has never been tried before. So we still don't know yet. So we continue to have this experience around the world where, everyone is, forecasting some kind of a hard landing somewhere to develop. And yet it still hasn't happened yet. So it's a bit of this awkward moment. But the Canadians right now, yesterday you fully expected them to come out and say, yeah, it's all going as planned. We're not going to hike now, but we will hike if we need to. Guys, they're not going to hike again. There's no more rate hikes coming from Canada. But we'll see now if things continue to get. If things continue to trend in that same direction that they want.
So, Rich, before we jump over to you, I think he also signaled. I mean, obviously, I think they have to, but I think they were signaling, or they mentioned in their commentary, people that are markets that are trying to price in rate cuts from the Bank of Canada this year. He pushed back on that. So, yeah, it just seems kind of like an ongoing pause. Nothing too exciting. But Rich, I don't know if you had any sort of takeaways from any of that.
Yeah, well, I'm going to give Tiff Macklem some props. I listened to the presser because it was kind of a slow week, and I'm quite impressed with his French. He used really, really big words, and he did it with aplomb, and he was really, really good. I have to say, I was super, super impressed with his French. So I tip my hat to Tiff. So that was one of my takeaways.
Are you fluent, by the way?
I am fluent. Je parle français plus ou moins bien. But I'm quite proud of being Canadian. I think it's amazing that our central banker did it in both official languages. I venture a guess that we're the only country in the world whose central banker can speak both French and English. So there you go. That's one
and
tip of the hat
to be fair, that's a very important attribute for any central banker to be able to. No, not. It doesn't matter.
Of course not. No, of course it doesn't matter. I just think it's cool. That's all. No. Don't get me started on diversity, equity, and inclusion. That's anyways, we're going to get in trouble now. But no, I just think it's cool. That was it. As far as the actual policy stuff, so there's a bit of controversy, boys. I thought it was much more sort of hawkish than I was expecting, given that it was a obviously no move. And given that he was arguing that, that, you know, I agree with Keith, they're not going to raise rates. So Rich, how can you say that it's hawkish if they're not going to raise rates? I think a couple of things. One is that he said, you know, he mentioned the services price inflation. You know, to quote him, it says services price inflation also remains high and is expected to decline only gradually. This will take some time. And then, so I think, and then he also said that the biggest upside risk is that services prices inflation should be stickier than projected. So this is something we've talked about a lot because, well, where sometimes we get stuff right, I guess. But I think that's the part he said, you know, that's really important. And there's just to add on, you know, if the labor market remains tight, which, you know, and then he said, I think inflation, it'll take, and companies believe they can continue to pass on higher costs without restraint because consumers expect higher prices. So again, something we talked about, which is the inflation expectations if they get entrenched. And he said, then inflation will take longer to get back to, or he said, inflation will take a while to get back to target. It'll be more difficult to get back to target. So yes, he's clearly not going to raise rates, but I think that what's coming through here is, number one, the services, two, the inflation expectations, and three, the labor market thing that we've been talking a long time. So I thought that was sort of, in my view, that was sort of different, or it was interesting that he highlighted that.
And he had
What about you,
revised
Steve? What-
GDP forecast higher.
Sorry?
They revised GDP forecast higher, I believe.
Yes. Well, we have lots to say on that, don't we?
Say
I think
it.
they didn't. They pulled it ahead a little bit, didn't they? Didn't they just they pulled some into 23 and then reduced their
So I mean,
estimates
well,
for
I'll
24?
I mean, they said that they, you know, I'm not a big fan of forecasts, and I think it's unfair to sort of like hold for like these guys to these forecasts because, you know, things happen, of course. But, you know, they said, you know, what I just thought was they crystallized something that we discussed quite a bit, which is that Canadians will be poor on a per capita basis by the end of this year. And I'm sorry, I'm laughing because, again, it's just so absurd. And it's because they think GDP, the global economy will grow by 2.6 and whatever. But effectively, what they keep talking about is growth is going to be okay. Growth is being okay. But they skate over the population thing over and over again. And that's a question that I thought was really interesting that they didn't ask. And again, I think it's just too controversial. No one wants to be a jerk. They're saying immigration's bad. No one's saying that. Again, it's about the per capita number that I think will continue to weaken. Remember, we're still below the pre-pandemic peak and now falling. It's 2 quarters in a row now that our per capita GDP is falling. So that was an interesting sort of wrinkle as well.
Apparently, I was just reading some stuff on Twitter here. Stats can put out these estimates and stuff. They've actually upgraded their like dashboard for a lot of their data analysis so that you can go and look at it. But anyways, apparently, so we had 1 million people in 2022. Apparently, they're targeting 1.5 million in 2023. Now, they don't target foreign students and foreign workers and stuff, but they do target higher PRs. But apparently, the projections are potentially for 1.5 million. Now, keep in mind, the Bank of Canada also flagged this in the report that a lot of the immigration that's coming through is the inflows are skewing heavily towards temporary residents. So that could add to the volatility should the economy roll over and there become, you know, less jobs, then people could obviously leave the country, and all of a sudden, you know, that narrative or that story that's supporting housing, for example, could actually see outflows.
That reminds me of another T word that I think we should absolutely question. Certainly, remember the whole transitory, how they told us that inflation was going to be transitory? Well, I'm going to go out on a limb and say that this temporary workers, I'm going to bet you that they're going to stay in Canada because Canada's a beautiful place to live. And why would you, given where we know these people are coming from and the age at which they're coming from, remember, I actually screwed up that stat a little while ago, but anyway, they're basically mostly young people. My bet is that they're not going to go home. They're going to stay in Canada because Canada's great. So I think I call BS on that.
They're all wearing jorts now in Halifax.
Oh, there's one more thing. Sorry, there's one more thing. One of the questions from the reporters I thought was really interesting, and Tiff I'll give him credit. He skated right around this like a dirty hip check in the middle of the ice. Somebody referenced the deficit spending and if deficits would have an impact on inflation going forward. And oh man, I'm giving him lots of props today, so I'm fair and balanced. He's just like, no, it's incorporated in our model, blah blah blah. Of course, if you run major budget deficits and you massively blow out your budget, of course it's going to have impacts on inflation because, and he admitted as much, although it was a slight little, you have to be really listening carefully. We're already above potential GDP. And by running those deficits, you are basically entrenching yourself above potential GDP, e.g. And so you have like a positive like output gap, and a positive output gap is inflationary. Anyways, so that's sorry, it's done.
So
I'm done for now.
He saved his job, is what you're saying.
Yeah, exactly. No, but credit to him, man. He did a really good. He just skated right around that because, like, what is he gonna do? He can't like throw his benefactor under the bus, right?
Man, I think Rich is on fire today. You've been right. I think you might do like a Gordie Howe hat trick by the time the episode is over.
Who's he fighting?
And not me. I hope it's you. But no, Rich is right in that. No, especially the comments, about the deficit and everything. And I mean, like, these guys, unlike the Loonie Hour, these guys actually go through all the different scenarios, what could come at them during the presser and everything. Because I think if you know us, we sort of just show up and have a chat. So you knew that question was going to come. The central bank is supposed to be neutral and all that. However, it ain't neutral. It is going to say, it's not going to say anything negative towards Ottawa, no matter who is running Ottawa at the time. So, but Rich made some really good points in that on the face of it, it all looks pretty nice in Canada right now, and that they're on the way to achieving, the Bank of Canada are on the way to achieving their monetary objectives. However, underneath the hood here, they have to be concerned, especially about the banks and the housing market. There's a really good data point came out a few days ago about down in the US, all the banks were selling off their mortgage portfolios. And so, banks are getting this stuff off their books. The question is that, well, somebody has to be buying it. But, the banks, they are quarterly reporting financial entities that are levered, 10 to 30 times. So they have an incentive to get this stuff off if they have to. Whereas the people who are buying it are usually pension funds, and, they don't have quarterly reporting. They have generational time horizons and stuff like that. I haven't seen the equivalent transactions taking place in Canada. So I don't know what's happening up here. But I can assure you the Bank of Canada, it wasn't mentioned this time during the presser or in the monetary policy report. I don't think it was, but they have to be concerned with housing, but more importantly, concerned about the banks and their mortgage portfolios. So we have banks coming out again soon with their earnings report. We'll see what they're doing with provisioning, but this is going to snake its way through here.
On the mortgage side, I'm curious what your thoughts are. Would you be more concerned? I have my opinion, but would you be more concerned for the bank's portfolio regarding their sort of commercial mortgages or residential? I mean, I would argue both, but
you're always more concerned with residential because it's so much bigger than the commercial side, right?
Okay, interesting.
Yeah, it's a lot bigger. So because of that, just a small move, Rich, you're good with numbers, right? A small move on a bigger number can overwhelm a bigger move on a smaller number. However, but if you're using the the U.S. market, as a barometer or a benchmark right now, increasingly there's a lot of concern about the CMBS, the commercial mortgage-backed security market down in the U.S. And I know, Steve, you introduced this to our conversation a few weeks ago, and it's coming up as well. So banks don't like to lose money in any market they're in, but the residential side is bigger than the commercial side. So maybe they get hit on both sides. I hope not, but
it's kind of interesting when you kind of like peel back the onion, because if you saw, it was in San Francisco, it was a Salesforce just dumping basically 100,000 square feet of office space, prime office space in downtown San Fran. So it's like, a massive tech company like that, just paring back some of their office space. And like, you look at San Fran, they've kind of been like, it's a major metro where, I mean, they've been hollowed out, right? Like all the tech layoffs, followed by like work from home, pandemic stuff. And so it's like you have all like basically the downtown has become like this like vacant dumping ground. And
yeah, but San Francisco is also, sorry to interrupt you, but it's like The Walking Dead there. Like it's horrific.
Right. No, I mean, I agree. But then it's like at the end of the day, it's like, well, someone's issued loans against the collateral of that real estate. Number one. And number two is how much of the city's tax revenue base is based off of property taxes and revenues coming in from those. I don't know. I just find it interesting. I think that
it's Steve. That's California. That stuff doesn't matter out there.
Yeah, just forget
further
about it,
inland to see real economics.
Well, I just find it interesting because, like, we talked about on the show a couple of weeks ago, which is like Calgary already went through this post the oil collapse in 2014, 2015, where all of a sudden, all this empty office space came up, and then now we're sort of seeing it a bit on the tech side.
And the Calgary space, it's still quite empty-ish.
It's like 20. The numbers, I think, officially, like the occupancy rate is about 22, 23%. People argue that it's closer to 25 to 30 still. So you just have a lot of buildings. Again, they just
sorry, vacancy rate or occupancy rate? Sorry,
so vacancy rate.
Yeah. Okay. Sorry.
Yeah. So it's basically a quarter of the office buildings essentially are vacant. So.
There was another thing that Carolyn Rogers, the deputy governor, said, which I thought was interesting that just came to mind, which was I think one of the reporters, I'm going to screw this up, so forgive me. One of the reporters effectively said, why wouldn't, if these inflation issues are still entrenched, why wouldn't you raise rates further or something to that effect? And again, sorry if I've garbled it, but, and then Tiff, passed her the puck, and then she made some reference to how there's still, it's only effectively, she's saying it's only been a year really since they've raised interest rates from whatever 0.25 to 4.50 or whatever it is. And, I'm reading between the lines is I think that there's some more pain to be felt from the debt servicing costs and how they're still feeding through. So I was just wondering and then that's why I want to ask you, Steve, I mean, is that something that you're sort of, when people are sort of approaching you for homes and stuff, is that, I know that obviously, their affordability has changed, but is that something that people is anybody selling out of their homes to go smaller because of that? Or is that, maybe I'm just overthinking it?
Yeah. Anecdotally, yes, I've had a few of those conversations and, chatting with other realtors that have their clients and why are they moving, why are they buying? And so, yes, anecdotally, some of those conversations are definitely coming up. I know that the Bank of Canada mentioned that, higher interest rates still have yet to bite for a lot of Canadian households because, for example, people that are coming up on their fixed rate mortgages for renewal, all of a sudden you're going from a 3% mortgage rate to 5.2% today. And so like that's going to sort of feed through. And I think that is the case. It's interesting because like on the residential side, we've talked about on the show is I think we're kind of like in timeout period right now. We're on like a break, which is like, the housing market right now, prices are actually accelerating higher because you've got people not listing their houses on the market. You have a 20-year low nationally in new listings. And so it's kind of suppressed like what I think should still be a correction to the downside, given where mortgage rates are, given where, if you look at the RBC's affordability index, it's the worst it's ever been. Like people are paying, we're seeing right now is we're seeing, a lot of these entry-level houses going back into multiple offers, 5, 10, 15 offers on a house right now. Very, very common. And people are bidding them up, not quite to the peak prices of last year, but like we're probably only maybe 10% down from those peak prices at this point. And, mortgage rates are still in the 5s. So, and I think that's more a factor of there is no new listings. And I don't think 20-year lows in new listings is going to be sustainable. I think at some point we're going to have some sort of normalization in listings coming to market. And that maybe could resume your next sort of leg down potentially, but you need to get inventory off what it is right now, rock bottom lows. And that is not going to happen overnight. So maybe that comes with a recession and job loss. And I don't know. I mean, Keith, I don't know if you have any comments on this, but that's how I'm looking at it.
I mean, one thing I love about the housing market, it's, at the end of the day, it's just simple economics. It's supply versus demand. That's what it comes down to.
It's very emotional on the residential side.
Sure. I'm not an emotional guy.
No, I know you're not, but I'm saying like the people that are out there competing right now, I'm surprised that people are willing to compete with 7 other bidders and bid up a house when you're like, people are talking about recession and mortgage rates are in the 5s, and you run your mortgage calculator like, oh, that's a really large payment.
Yeah, you're absolutely right. And I'm joking, by the way, not about being emotional, but about, I do know it is an emotional purchase, and you can be looking for a long time, and finally you find the dream home, and you got to stretch yourself. And then, you're told, well, 10 other people have bid, it suggests you do this or that. And I know what that 24-hour period could feel like. But just from a pure investment perspective, if you have lower supply or supply is not catching up with demand, I mean, yeah, absolutely, we're going to have these periods coming through here. But the most important thing, though, that you mentioned, Steve, is that, that can get corrected pretty quickly. It takes a while to correct supply, of course, but the demand side can be corrected. And that is with this magical recession, that we continue to expect we're going to get some kind of a slowdown here coming up. And but everyone's been expecting that. It was gone from Q4 last year to Q1. Now maybe in the second half it's gonna come off. And no, now it's gonna be 24. And hey, maybe we will have that soft landing. But if we don't get the soft landing and someone falls behind on debt payments, whether it's at the government side or household or corporate, that's when it begins to tumble very quickly. So I guess the point here is that we are not out of the woods yet, by no means. Like, don't confuse like a nice warm and fuzzy Bank of Canada meeting with, it's safe to go back out and do stuff again.
You want to know a really interesting stat, like just kind of rounding out our conversation regarding the commercial real estate space with your residential. So you've got the residential space again that's been more resilient because you've had this very lack of new listings. There's a tweet out the other day from a guy named Brandon Donnelly. So he's in the development space. He's got a very widely followed newsletter in the Canadian real estate space. So he's a pretty well respected guy. So he tweeted, he says, a big bank just told me that they haven't done a development acquisition loan since the spring of 2022. This is a leading indicator for new housing supply. So basically what he's saying is one of the large banks that he was chatting with, they haven't issued a new loan for the purchase of raw land in Canada since the spring of 2022, which is
all of Canada.
Yeah. And again, he didn't tweet and mention which bank it was, but
no, I got you.
This is a pretty well respected guy. This isn't some like random on Twitter that's just firing, stuff out for clicks.
That's really interesting. Yeah. It's how long, like for that 1 year gap, basically, has it happened before?
Well, I know. I think that the big thing is like, you chat with like developers and stuff right now, like the numbers don't pencil. So you're like, you're running your numbers. The cost of the land, like, it hasn't really come down because there's not a lot of turnover. So you're not really getting any of that price discovery. So the cost of land acquisition is still really high. Your cost of construction, while your costs have moderated, it's still really, really expensive to build. And your cost of financing the build is extremely expensive. Construction financing costs right now. That's so like you're running these numbers and you're saying, okay, well, when I build this condo and have to pre-sell it to the market, what am I going to get? And like, yeah, the market has firmed up on a price perspective, but prices haven't really gone up. They're still down from what they were 12 months ago. So anyways, you run as a developer running a pro forma, the numbers don't really pencil. And so I think you kind of have this bit of a standoff where, yeah, ultimately, the way I look at it, say, okay, well, we'll probably see supply shortages. We'll see this filter through into the real market 2, 3, 4 years from now. The lack of new housing starts. I think the big thing too is what's the economic drag of that, right? If developers aren't out there buying new land, running permits, starting construction, I mean, that's a huge component. Rich, you know the data, like it's a huge component of the economy.
Yeah, we're already seeing the drag, right? I mean, this is what I mean. Not to like be a broken record, but this is what we talked about. I think 6 or 7 months ago. It's like when you have a housing bubble and so much of your growth is devoted to residential investment, gross fixed capital formation is sort of the fancy way of saying it. In residential, remember we talked about how it was as high as it was in Ireland and Spain, so upwards of 8, 9, 10% of GDP. When you do have the pullback, it's very, very difficult to not have a sustained drag on your GDP growth. So I think that we're partly seeing. But can I ask you a question, Steve? So, we talked about the rate reset and we talked about like low inventories. I'm always trying to figure out, new and interesting ways of sort of getting a bead on economic data that maybe people haven't thought about before, or maybe gives you better real-time data, or sometimes I just try to be clever, which often fails. But would you suggest that if we do see a significant uptake in inventory, that's reflecting the rate reset biting, or am I being too cute?
Might be a bit too simplistic. I think there's definitely going to be people that are like holding on, though. I mean, I definitely think like mortgage arrears are going to increase over the next 12 to 18 months for sure. But like, is it going to be enough to like oversupply the market? I don't know. I'm a little bit skeptical on that front. I think you're going to need to see a recession, and then how deep is that recession, and how many jobs get lost. Basically, you see the foreign workers kind of leave, you see more houses hitting the market, a few more for sales, you see a little bit weaker demand, and you allow inventory to build. And when inventory starts building, then you get downwards pressure on prices. But right now, like, inventory is not building at all. So it's very weird. It's hard because you're running all these like data points and you're trying to sort of like predict the future and the direction of the housing market. And like, honestly, like not a lot of it makes a whole lot of sense right now.
Fair. Sort of in line with that, sort of moving away from Canada a little bit now. I just saw a great survey that came out this week. So they're surveying fund managers in both US, North American, and Europe. And in the US, 81%, they expect credit defaults to increase this year in 23. So 81%, that's basically everyone except, 2 lads, basically. And for the European number, do you know what that number is, Rich? Higher or lower?
I don't know. Bad.
It's probably lower because they're
what
always
percentage of European managers expect credit defaults to increase?
Oh, lower, definitely lower.
That's what I would have thought as well, right? You're thinking, hey,
they're more naive. Yeah, nothing bad's gonna happen. We got our Pinot. It's nice outside.
Don't get them started on the Pinot.
Did someone say Pinot? Hold on to your hat. Hold on, everyone. Maybe this is a hip check in the middle of the pitch. 91% of European managers expect credit defaults to increase in 23. So again, we keep going back to this environment where markets are pricing in a slowdown, which implies a recession, credit defaults. They're expecting central banks to turn dovish, start cutting rates and things like that. And yet we're not seeing it yet in financial markets. So we still have that disconnect. I know last week we talked about, suddenly we shifted from where, bad data was good to all of a sudden bad data is bad. And this week I think we're back to bad is good again.
Yeah.
But it can be a bit
like the
confusing.
housing market here too.
Yeah, it can be a bit confusing. But again, I just want everyone to realize, we do this from a Canadian centric, of course, but you have to appreciate how things are developing outside of Canada. And again, the expectation is for the economy to deteriorate. So that's both in the US as well as Europe. I didn't see any Canadian data, by the way. And then if you have a deteriorating economy, it means that there's job losses, less earnings growth. It means, some folks aren't able to pay their debt back, and you get write-offs and stuff like that. But we continue to go down that path. That's where we're going. I saw something interesting as well this week with Warren Buffett. Did you guys see that?
Before you go on to that, but I want to just add something to your point about sort of deteriorating data, which is so there's this thing called the U.S. recession probability indicator, which is from the New York Federal Reserve. I will share it in the Loonie Hour Substack, and it basically uses the yield curve as part of a larger model. I think it's a Logit or Probit model. Anyway, it's too complicated for me. But the point is that now there's a 57.8 probability of a recession in the next 2 to 6 quarters. And I think that speaks to the issue I think we're sort of having, which is this holding period of not quite we think bad things are going to happen, but it's all about when, in our
6
business.
quarters, man. We're going to be episode 200 announcing.
Well, God willing, but this is the problem where you have this, this yield curve, and the yield curve models that sort of, that sort of mushroom off that. And unfortunately, there's sort of a wide range as far as timing is concerned between 2 and 6 quarters. I mean, that's what, a year, that's half a year and a year and a half. I figured it out. And that's a long time. A lot can happen. The Leafs lose in the first round twice in a year and a half. I mean, a lot of things can happen in a year and a half, but I think that's the point. Sorry, Keith, but go back to Japan. But I think
we're not going to be invited back to the Hockey Hall of Fame with those comments.
Oh man, Rich is a great Canadians fan. Hey, whenever they don't make the playoffs, what do? You bash the Leafs.
Well, if we lose, I don't want to jinx it, but if we lose next game and Arizona wins, we'll be in the lottery for the great savior Connor Bedard. So wish us luck. Anyway, Keith, tell us about Japan. Sorry, Keith.
No way we're ending the podcast on that. So okay, let's go to everyone's other favorite, in hockey player. That didn't work out well. Warren Buffett went to Tokyo this week. And the guy doesn't travel around too much. I mean, how old is he now? How old is Warren?
Isn't he? He's
88 or something. Oh, look it up.
Munger must be 109 or something. I mean,
the original boomer.
Yeah, he had a great interview a few weeks ago.
He's 92. Warren Buffett is 92.
He looks pretty good for 92.
He looks great.
Yeah,
it's all that Diet Coke, man.
It's and McDonald's. Don't forget the McDonald's.
No, Dairy Queen. He's a Dairy Queen boy.
Oh, sorry. I knew it was something horrible like that.
He owns Dairy Queen. Anyway, so back a bit more serious perspective. So he went to Tokyo this week, and he owns shares in the main Japanese banks. You're trying to figure out, okay, why the hell would Buffett go all the way over to Japan? Right, it's not a nice weekend trip at all, and so he's there. So that should catch your attention. Then you'll step back and say, why is he in Japan? Okay, he has investments in Japan, of course. He's invested in banks in Japan. And what's happened with the BOJ over the last week? Steve,
you tell me.
Rich.
Again, they're getting hawkish a little bit.
Well, they have the new governor has now officially come on. I don't know if he's called the governor. I don't know what he is with the.
It is, I think. Yeah.
Yeah, the governor. Anyway, they're trying to figure out what's going to go on here. So the fact that he made this special trip to see the banks basically in Tokyo, it implies that something is coming down in Japan. So whether they're going to relax the yield curve a little bit, or I don't know if they would hike short-term rates, but that would adjust the yield curve as well. But it's likely something is happening in Japan. So he's there he's not figuring out. They're telling him what's going to happen.
Or maybe he's telling them what's going to happen.
Yeah, maybe so. He might say, hey guys, I'm pulling my equity out, whatever. Because if you guys probably don't remember, because you guys were quite young then, but when the housing market broke in 08, 09, Buffett helped to recapitalize the US banks with a convertible preferred share. Like he got probably the greatest financial deal in the history of all histories back then. And everyone thought, oh, he's just being, real nice, Uncle Warren or something like that. No, this guy has become extremely wealthy and successful because he's always on the right side of the trade. And it's not from, crunching a spreadsheet or anything. So don't be surprised to see some big news come out of Japan over the next few days or weeks or something like that. So this is something we remember, we talked about this a few weeks back when we said, the opportunity is there now for a lot of Japanese foreign investment made by Japanese entities. So they have their money across Europe and the US and Canada, stuff like that. So for that money to start coming back home, it has potential just to push the yen incredibly higher. It could cause the bond market to come off quite a bit, things like that. But this could be something. It's not coming out of the blue because the Loonie Hour is now telling you about it, and all of our friends in Ottawa and Bay Street who are listening, you're getting a tip on it as well. But this is a big event. It's not getting a lot of attention, but it certainly should. Steve, what was your question?
Can you walk me through that? Perhaps the listeners that are trying to figure out what the implications are here. So let's just say new BOJ governor says, hey, you know what? 2 decades of zero interest rate policy. We're going to try to maybe gradually move away a little bit from that. We're going to start hiking interest rates. What is Warren Buffett thinking as a guy that has a position in some of these Japanese banks?
Yeah. So first of all, you got to figure out is your at the bank are your assets, is it asset sensitive or is it an asset liability sort of exposure? Because each bank can be somewhat different with the way they're positioned. So, I mean, they would give the banks a heads up before something like that would happen. And just as the Canadians would do the same thing, and the Americans and Europeans, and you're not going to do something to cause a run on your banks or cause these abnormal losses on their balance sheet. So he's there and he's figuring, okay, this is what our exposures are, and this is how we could potentially make money on it, basically. But again, they would be giving the banks the heads up because he's involved with those banks. They're going to bring him in because he has the power to attract a lot more capital or to even take capital out.
So essentially, rates up, these banks suffer losses on their bond holdings.
But they also improve their net interest margins, though, right? Remember, banks sort of borrow short and lend long. So if the yield curve if they're talking about changing the yield curve or what have you, you have a situation. Some of these banks could go from never making any money at all and to making a little bit of money. Am I getting that right, Keith?
Well, true, but wasn't that what we were told in the U.S.? And now, obviously, we're seeing with the issues that are emanating because deposits are basically leaving a lot of these smaller banks.
Slightly different, though. Net interest margin in the U.S. are as high as they've been in 2 or 3 years. So I think that there's like the SVB kind of badly run banks that have gotten squeezed by higher rates. But some banks are well, we're going to find out this week because it's good, or this month rather, because it's earnings. But I think that there's banks that are making lots of money on higher net interest margins. But Keith's going to correct me if I screwed that up.
You're there. You're there. It's such a big. The American market is it dwarfs everything else. So you can have some parts of the market that have very good net interest margins. Other ones that, like the NIMs, have been declining. Actually, each bank can position their balance sheet differently. It's not you can't use a broad statement for the U.S. market. But ironically, in Japan, like if the Bank of Japan, if they allow the yield curve to either shift higher or let the long end go up, I mean, who loses the most money on that policy move?
The Japanese people. They own 95% of the bonds, no?
Central bank, yeah.
The Bank of Japan, the BOJ, yeah. They could have like gazillions of yens in losses on this. And it's no big deal, right? It's really no big deal. But the point is, though, it could attract a lot of money coming back. So instead of looking at the perspective from Japan, you have to look at it from the perspective of elsewhere. Because if capital goes into one market, by default, it's leaving another market. And, the Americans will lose some capital, the Europeans are going to lose capital and stuff like that. So we'll see what happens with it. We don't know the answer yet, but we know something. It is big. It is big.
Are you salivating over Japanese government bonds here or what?
I wouldn't be buying them, put it that way. If you want to put a short on, it's pretty easy to do if you can trade futures. But we have that happening.
There's another thing that happened in Tokyo, which was that Warren Buffett admitted that he reads my Substack because he was basically talking about the energy transition and how it's a total waste of money. And he didn't say that exactly. Sorry, let me tone it down a little bit.
What's his big oil and gas holdings again?
Oh, I can't
Occidental.
remember. Sorry, I can't remember. But he did make a point. He said basically, you will still be consuming the same amount of oil in 5 or whatever years, and that there's not sufficient capex to meet that demand. And this is something I've been saying for a long time. And this flies in the face of a lot of the prognosticators who say that we're gonna, decarbonize and move away from oil and what have you. And he's obviously played a lot of the inside game over the many years, but he's a smart old man. I think we should listen to him. But anyway, that was just tongue in cheek, really.
Uncle Warren.
He's a smart old man.
You're a smart old man too, Keith.
Hey, thanks, man. Thanks.
So we've got we're just chatting the group chat there, but we've got, a couple data points. Is US CPI was out this week. So Rich, if you want to unpack that as well, but also it was the money supply growth, which, rightfully got a lot of attention during the depths of the pandemic when it was shooting up like a hockey stick, exponential growth. I think what M2 grow like 30% year over year at one point. And now we're rolling over, now contracting on a year over year basis. Again, this is the rate of change, of course, but it's interesting to sort of overlay that, Keith or Rich. I know you've got some models even at Acorn there, sort of trying to forecast inflation. I know you use a component of money growth as well.
Yeah, I don't like models. I think people get married to them. I think people sort of fall in love with their models, and then instead of thinking about what's going on, they just repeat the model. But I do, in fact, have a model, and I think so. For me, it includes money supply, producer prices, which are they often lead consumer prices. That's not unreasonable, or that's actually rather intuitive as well. And then the shelter component, which I will not reiterate, Steve, so that you don't kill me. But it's clear that money supply is definitely falling, no matter how you basically cut it. Whether you strip out the Federal Reserve balance sheet, whether you strip out excess reserves. The reality is you are having a contraction in that money supply growth. Now, to be honest with you, I don't really have a clear view. Part of me thinks that this is a natural occurrence. We had an incredible we over-egged the system, both on the fiscal side and on the monetary policy side. And this is sort of the deflating of that, and maybe this is the wrong word, but bubble, basically, that enormous sort of that policy push. And so it's kind of natural that after such an enormous expansion that you would have some kind of contraction. So that's one side of it, and then that's sort of maybe the sort of more rosier side of it. The negative side is if you do have a contraction in money supply, that is a harbinger of credit contraction. That's a harbinger of tighter monetary policy conditions. That's very, very, very bad for the economy. To be honest with you, Steve, I don't know. I'm a little bit sort of in the middle, which is maybe not the most exciting answer, but I just sort of haven't figured it out. I think there's like way too many moving parts. I think it's too easy to just say, money supply growth is negative, we're screwed, I think it's a lot about bank lending, which actually is also slowing. So,
well, I'm kind of curious, Keith, your thoughts, because I know everyone seems to be talking about a looming credit crunch, given the the issues with deposits in a lot of these regional banks in the U.S. and obviously the turmoil that's happening, for example, in commercial real estate. Naturally, banks are pretty hesitant to issue credit, and credit being the lifeblood of the economy. So, kind of curious how how you're looking at some of the data, not only with U.S. CPI but with monetary M2 growth.
Yeah, I think it's a lot easier, actually, if you just look at the growth year after year and just take the number for what it is and not read too many things.
Nah, you got it.
Rich is rolling his eyes now. Rich and I have a lot of fun talking about these things, and but that's just a thing with any kind of data point or metric. Sometimes you really tear it apart and go, yeah, this nut fell off there, and it's that's what you needed to think about. I just think that, with this data point, year-over-year growth rolling off so quickly. That's what threw 2022 off, from a risk on, risk off perspective. And it continues to happen here. And I think it's just really a function of where the central banks have now reached the point where, I think the Fed will end QT at some point soon. That's what they'll have to do. And
this year.
Yeah, I think we're getting close to that day. It's happening, and they might have to end it really for like non-monetary policy reasons. It might be for other, like overnight, repo markets and stuff like that. So and there's other things happening, but I think the point, though, right now everyone is sort of looking at CPI data and PPI data. It's giving you the signal that the central banks are going to have to stop tightening. They're going to definitely pausing and maybe cutting, and it's risk on. But that's we're in this transition period, and I suspect that's going to tighten up. It's going to be pretty hard here at some point soon. So right now, so today's Thursday, right? So it's a pretty green day out there in the market. Like Canadian dollars flying,
green shoots.
It's green shoots, green bean stalks, and everything. It's looking good. Looking really good.
But that actually brings me to the inflation print, which I sort of jumped over, which is the inflation print, headline fell to 5.0 from 6.0.
Estimates were 5.1, I think, coming into it.
5.2. And that one, now this is going to get complicated, that 1% drop of the year-over-year number, oh God, was actually a huge decline. I think it's only happened like 6 times in the last 40 years. But that's the headline figure. And that headline figure is getting dragged down because of energy prices. So, okay. But there's a couple of things that I think were under the hood that I thought were really interesting, which might allow us to push back on this Fed's going to cut all this stuff narrative, which is, we've talked about the breadth of inflation in the U.S. It hasn't at all slowed, so that's important. And then one of the series that I really like to look at, which is the core, and Steve, you will like this, core X shelter. And that stopped falling year on year and is actually was flat. So it's at 3.7. And so to me, that was a huge, not red flag, that's a bit too strong, but it's something, next month, that's the only thing I'll be looking at. Because if you have a situation where core X shelter is starting to stabilize, but at 3.5-4%, and then you get the fill up from energy prices and all these consumer goods, which again, remember we talked about this, the contribution went from very little to a lot, and then now it is back to a little. But what if energy prices start to crawl up again, and you get a situation where your headline stops falling, and then that core X shelter component hangs out in the threes, 3.5, 3, 4, and then again, finally the coup de grace, which is the PCE services, which hasn't at all stopped falling. And so if those 3 things sort of happen, I think the view that the Fed's going to cut or whatever, I think that's way too dovish, and I think it'll surprise people.
Mm-hmm. I don't think I know people are saying, hey, the Fed's going to cut. They're going to cut. They have to stop hiking first, right?
Yeah,
and I'm not trying to be funny.
No,
with it,
no,
right?
But you're right. I'm sorry. You're right.
Yeah, and I can be a real funny guy when I need to, but they have to stop hiking first, and that's the call. But the real challenge, it really feels like we could be heading this, this textbook stagflationary environment. Maybe inflation remains sticky at the 3% number or 4 or something like that, and the economy rolls over. But the numbers are rolling off, and we knew that would happen. Where the floor is, I think we're getting closer and closer. The elevator's coming down. Is it the 4th floor we stop at, Rich, or the 3rd? I don't know, but we're getting closer.
I take the stairs.
You take the stairs. I'll take the elevator when it's.
He's got an elevator in his house.
Yeah, that's right.
An escalator. Get it right. Did you hear about France this week?
I heard about Germany. Tell us about France.
Okay, so yeah, let's go with the German. But real quick, these are just interesting things. They're not a market mover, but they catch my eye. So this week Macron went to Beijing to meet with
Yes.
Xi Jinping, and
Winnie the
he
Pooh.
announced we want to build a strategic autonomy away from the U.S. And of course, that's just another way of, also saying, I want to kiss China's ass. That's what came out of that. But politically, this is pretty important. There's a lot of, fissures developing around the world right now. We saw what was happening with China and Taiwan this week, which was pretty amazing if you think about it. But
this
for France,
this BRICS talk is getting exhausting, by the way.
The what? What talk?
This whole BRICS conversation. The end of
BRICS.
the US dollar.
Yeah, absolutely. I was thinking of another BRIX.
It's like, it's like Twitter's a great
about?
Sentiment indicator, and like when everybody is posting about BRICS, it's just ringing the bell at the top.
Yeah, it could be. But here's the so-called leader of Europe right now, because there's no other leader in Europe. Think about it. He's not coming out of Germany right now. But he's basically goes to China at the exact same time the Americans and the Chinese are staring each other down over Taiwan. And he comes out saying, yeah, we want to move away from the American. Meanwhile, the Americans have, all their troops lined up along the eastern border in Europe to protect them from this and that. It's just this partial experience. I mean, I'm just looking at this and I'm thinking, what the heck is it? Of course, it is a way to deflect attention away from what's happening in Paris as well. But this European place that we all hear about, it's just weird, Rich. It's just weird. Now, of course, France linking to China in one way. At least we don't have any of those links here in Canada, so we don't have to worry about that.
Zing. No, Canada has no links to China whatsoever.
Cut, delete.
CRTC, if you're listening, please don't ban us. Anyway.
What were the Germans up to? What are they? I know the answer, by the way. I know the answer to my question, but what's the German news this week? Which was very interesting, by the way. It's a bit of an eye roll, but it's a fact.
I mean, despite my proclivity for pumping oil and all things oil, I actually think that eventually we'll need to move away from fossil fuels. And the way we will move away from fossil fuels is by exploiting a technology that is older than Keith, if you can imagine. And that's nuclear power. It's nuclear power, and the Germans do not agree whatsoever, and I'm just absolutely furious by this. The Germans shut down their 3 remaining nuclear power plants. They either did it a couple weeks ago, or they're going to do it in a couple weeks, and I just want to express my outrage at how freaking stupid that is. In 2004, the Germans produced 160 million megawatt hours of nuclear power. For those who aren't following along at home, nuclear power is emissions free. Yes, it's expensive. It's not at all dangerous. I will fight that myth tooth and nail. But whatever. They had an entire apparatus that produced carbon free or emissions free energy at an enormous scale, and they have shut it down, all of it down. First, of course, it got started with Fukushima. Germany is not near Japan, as far as I know, and nowhere near a fault line. And yet the Greens and sort of the feckless politicians in Germany have spent the last 20 years shutting down all their nuclear power plants. And I think it's a freaking outrage. And if you care about the environment at all, you should also be outraged by that. And so I'm sorry. I know that's like a total tangent. But forgive me, I had to get that out, or else I was going to explode like a nuclear power plant. No. It's just nuts. It's absolutely nuts. Like just to give you perspective here, like there are certain countries like France, back to France, something like 75% of their energy needs are from nuclear power. Have been for years and years and years. There's, Ukraine, God love them, same thing. I mean, there's loads of countries that South Korea is building nuclear powers at an increasing rate, not only at rate, over less time for less money. The safeguards, the engineering's better. I mean, if you care about the environment, if you care about carbon emissions or anything like that. What Germany is doing is a complete outrage. And I just thought that Canadians should know about that. So
Didn't
yeah.
Japan just run a summit like last week or something, basically saying like they're going to try to lead the charge again on nuclear power? And
Yeah, they have to. So Japan is a massive, massive net importer of energy. So they have no natural resources. Japan is wonderful in many, many, many ways, but it just lacks the natural resources that you would need. It doesn't have coal, it doesn't have natural gas. And what they do have is fantastic engineers and crap loads of cement. And so for a long time, they made a concerted effort, just like the French did after the oil embargo in 1973, to shift away from fossil fuels and move towards nuclear power. Obviously, Fukushima scared the daylights out of everyone. Fine. But obviously what's happened in the last couple of years with the natural gas prices skyrocketing, with oil being really expensive, the Japanese have walked that back. And they're going to, I mean, who knows what will happen, but my guess is that they'll start either rebuilding or expanding their nuclear power plant and production, electricity production, because it's, in my view, it's the only way forward. I welcome the comments to challenge that view, but it's really, really crazy what the Germans are doing, and it's shame on them, frankly.
maybe that's what Uncle Warren was doing in Japan,
Oh yeah,
firing up the old nuclear plant.
That's right.
Well,
Hey guys, I have to run because I have some work. Actually, work every now and then, but I have some work.
Some real job.
Yeah, but anyway, sorry guys, I do run. Thank you everyone for the week. Great conversation, and I'll leave it to you guys to tie it up. Hey,
I guess Keith is the one wrapping up this week. That's all we got. So leave us a 5-star review, hit the thumbs up, share it on Spotify, Apple Podcasts. Let's continue to build the Loonie Hour community. We appreciate it, and we'll see you next week.